Good morning, everyone. We will begin in just a few minutes at the top of the hour. All right, well, I have 12 noon, so in respect for everyone's time, without further ado, let's get into it. So welcome, everyone. Good afternoon. This is a webinar to talk about the 2023 Northeast Dairy Farm Summary, which is one of the most complete financial analyses of Northeast Dairy that's available. We will also have a market outlook and a kind of a mid-year update from Corey Geiger, who is the dairy analyst with CoBank, and I will let him introduce himself more thoroughly when it's his turn. Before we begin, a couple of technology tips. You should see a red arrow on the upper right-hand side of your screen. If you click on that, that will expand the control panel. There is a option, like a box with a little chevron arrow next to it for questions. You can open that up and you can type in your questions at any point during the presentation. We will pause after my presentation for questions, and then we will switch over to Corey, and we will have questions for him following his presentation. I will mention that this webinar is being recorded and will be archived at farmcrediteast.com/webinars. It'll be posted probably by this time tomorrow, and that way anyone that could not attend live will be able to review the recording. With me today is Rob Goodling of Horizon Farm Credit, where this year is kind of a bonus dairy farm summary, if you will, in that we included 50% of the farms roughly came from Pennsylvania. So we had 140 farms that came from New England, New York, and New Jersey, and then about that number that came from Pennsylvania. So it was interesting to see some regional differences, and it also made for a much more robust sample. So the agenda is we're going to have a review of the 2023 financial results. We'll have Corey Geiger's presentation, and then we'll have time for audience questions. You can download the full report at farmcrediteast.com. If you either search Dairy Farm Summary or go to the dairy page, you will see an option there to download the report. Alternatively, you can email me, and my email will be presented at the end of the presentation, and I will be happy to send you a PDF or a hard copy of the report as you wish. So some key points to the report. Net earnings fell sharply, as no surprise to anyone. 2022 was sort of a banner year for Northeast Dairy, or dairy in the US in general, because milk prices were quite high. The bottom line for 2023 was that input costs remained elevated while milk prices declined. And so the 2023 milk price averaged in the Northeast at $22.76 per hundredweight, almost $4 below 2022's number. And that very sharp decline was translated in the earnings and in the cash flow, as you can see from the bullet points here. The net cost of production did decline somewhat, but not by nearly as much as milk price. So we had net earnings of just under $300 per cow on average in 2023, down from just under $1,000 per cow in 2022. This year's sample of farms was 283 farms, including 143, as I said, from Pennsylvania. Although the average farm earned just under $300 per cow, that does not include debt principal payments, which have to come out of profits. So when you factor that in, along with other cash expenses, cash flow was insufficient on average to meet all financial commitments, resulting in an average cash shortfall of about 40 cents per hundredweight, which is quite a bit when you add that up to a whole farm basis. Also noteworthy is that both liabilities and assets rose due to the inflation of assets, as well as the increased capital requirements to run a dairy farm. So our total liabilities per cow, which includes both long and short-term liabilities, so that includes things like farm credit or bank loans, as well as things like trade credit and seasonal lines of credit. So if we look at farm milk prices per hundredweight, we can see that this goes all the way back to the beginning of the report, which is 1979. And we can see that milk prices were somewhat stable for a time and then increased in volatility until we got to like the 2000s, where we had severe volatility. And then we had a stretch from roughly 2015 to 2022 where milk prices were kind of in the doldrums. We didn't see the highs that we saw. Then we saw a surge in 2022, and then a kind of a correction, return to baseline, if you will, in 2023. This 2023 price doesn't look quite so bad. It was, over $22, which is normally a rather good milk price historically. But if we adjust for inflation and we go here and we look at 2023 dollars and then go back, the blue line is inflation adjusted dollars. So you can see it increases as we go back in time due to the impact of inflation. This 2023 price is kind of decidedly average, even though it was a high price in nominal dollars. When you take it back for inflation, it was really kind of in the middle of some of these ups and downs that we saw in the earlier 2000s and even the 1990s. So that 2022 milk price level, which as I said, on a nominal basis looked pretty good, not quite as sweet when you adjust it for inflation. And when you consider that input costs were sharply elevated in some cases, that resulted in some rather lean margins for dairy producers in the Northeast. Another thing I should mention is that we talk in this report and in this presentation about averages a lot, and the average farm did this and that. That really masks the significant variation in farm-to-farm financial results that we saw in the study. Despite the fact that the average farm had just under $300 per cow in positive net earnings, nearly a third of the farms in the study, closer to 25%, lost money last year. So, and then of course there's a number of farms that really sort of hit it out of the park and did remarkably well. So there's significant variation from one farm to the next. So even though we will talk about averages, I don't want to belie the fact that some farms did quite well and other farms really struggled. If we move on, we can see net earnings per cow again on an average basis from the 2000s. We can see the significant volatility. And the fact that we looked at, every so often we get an average losing year. 2009, of course, was by far the worst, but then we saw, near break even years in 15, 16, 18. And then we can see that we had a, remarkable year in 2022, although not quite a record. And then 2023, sort of a reversion back to baseline, if you will, or more of an average year. Net cost of production is something that we talk a lot about in the report, and it's one of the things that farmers and policymakers in particular often look at quite closely, because it shows what it costs to produce milk, basically, in the Northeast. So to compute this, we look at cash expenses, so what farms actually spent on a cash basis. We add depreciation in. We add family living, because the family members often work directly in the farm, so that's sort of a proxy for the family members' wages. And then we come up with a total cost number. Then we subtract what we call non-milk farm income. So that's non-milk, well, it's what it says. It's non-milk income that comes from the farm operation. And this can include things like crop sales, beef sales, as well as some side businesses if the costs are embedded in the farm business. So it often, in the Northeast at least, in New England at least, it often includes things like maple sugaring, custom hire, where the farmer custom hires out some of their equipment, or other sort of ancillary income streams. And so we subtract that and we come up with a net cost of production. Notably, it does not include any imputed or inferred costs for family labor. If the family labor is unpaid or underpaid, we don't put anything in for what they should be receiving. We just look at what the farm spent. We also don't include any kind of imputed net return on assets or net equity or anything, a return on equity. So this is really what the farm spent on a cash basis, including depreciation, without any inferred or imputed costs, like I said. And it also does not include any return on equity or return on assets to the farmer's investment. So it's really kind of the bottom line of what it costs to produce milk in the Northeast. And we're going to look at this regionally as well as by size. But this shows by time, and I will note some significant changes. One is that total cash expenses increased from 22 to 23, despite, as I mentioned, the previous slide showed the sharp decrease in milk prices. Depreciation increased as well. Family living increased quite a bit, and I'll talk about that when we get to Pennsylvania. The reason was, besides general inflation, which led to higher cost of living for families, our Pennsylvania farms had higher family living costs than our New England and New York farms. And the reason is not because they're living better or spending more money in their families. It's just many of the Pennsylvania farms are supporting more family members, so that the family living cost is higher. Notably, the non-milk farm income line was significantly higher as well in 2023. Some of that has to do with elevated beef prices for cull cows. And it also has to do with the fact that in our samples change a little bit every year, and we maybe had some more farms that had higher sort of ancillary farm income. So when you tally all this up, we'd see a slightly lower cost of production than the previous year, but still quite a bit higher than in just a couple of years ago. In 2021, just 2 years ago, it was $18.60, below $19, and it was $4 higher, jumping ahead to 23. So that's a notable change. If we look at cost of production by region, And I'll invite Rob to make some commentary here as well, but we saw some notable differences. One was that feed costs were lower in Pennsylvania than in New York and New England, but crop inputs were higher. And what I'm assuming there is that that's telling us that the Pennsylvania farms grew more crops, so they had a lower cost of feed, but higher cost of crop production. Many Pennsylvania farms also double crop more than we see in New England and New York. Rob, do you have any more to comment on that?
Yeah, so a lot of our farms in Pennsylvania, not all, most of them do double crop, which then allows for an increase in forage production or feed production off of that existing acreage. So that's why we're seeing a slightly increased cost on our crop inputs and a slightly lower cost on our purchase feed. There are a few other things that sort of to note. You've already mentioned about the family living. If we look at that labor cost, we do see a slightly higher labor cost, but then we have a higher family living cost. Again, the tendency for Pennsylvania farms is to have more family-based labor that's being pulled out of that particular line. Another thing to think about is just on average, the Pennsylvania farms tend to be smaller. So when we look at things like depreciation, while we may have a little bit more capital investment, number one, and number two, we have less pounds of milk that are being produced. So that per hundredweight basis of depreciation tends to be a little bit higher. And overall, on average, our production is usually a little bit lower than what we saw in New York and New England. So therefore, we have a lower denominator. Our costs tend to be a little bit out. But at the end of the day, when you look at that net cost of production, we are pretty similar in where that net cost of production does end out from a farm perspective. So even though we had some, a little bit higher costs in certain areas, lower costs in others, at the end of the day, for the whole Northeast, we're trending in a similar fashion from a net cost of production.
Yeah, and another important thing that I want to mention in this presentation, and I probably should have said it at the beginning, but these averages and these figures that we're exploring today are, this is not a statistically representative, fully representative panel of Northeast dairy. It's a sample of our, it's an average of our sample of farms that were that opted in to participate in the study, and this sample definitely skews larger than the average Northeast dairy farm by quite a bit. It also probably skews towards more profitable farms than the true average as well. So this is, I think, a very worthwhile and interesting exercise in looking at farm finances for dairies, but you can't necessarily extrapolate this to every farm in the Northeast and New England. And when I mentioned New England, our sample includes in New England, it's mostly Vermont farms, but there are some from Connecticut, Mass, and Maine as well. We didn't have any from Rhode Island in the sample. Rhode Island only has a very small dairy industry, and we didn't have any farms participating in there. If we look at the range of earnings, we break it in the report into profit quartiles. So this is representative of the significant range of profitability that we saw in the study. If we look at the bottom profit quartile, we can see that they lost substantial amounts of money, minus $300+ per cow. Our average, of course, was plus roughly $300 per cow. And then the top 25% still came up to almost $1,000 per cow in net earnings. Notably, the average number of cows, the average herd size in our top profit quartile was 100 cows less than actually the bottom profit quartile. What that says is not that all the farms in the top 25% were smaller, but that there was a mix of sizes, of all sizes represented in that top profit quartile. And when we look at to determine what's the top profit quartile, it goes by net earnings per cow. So we kind of control for size in that regard. So some of the smaller farms, like up to 100, 200 cows, actually were quite profitable on a per cow basis. Of course, per farm, they're earning a lot less because they don't have as many cows. But when we control for size, they did quite well, some of them. So that's why we see a difference in the the average number of cows. But nonetheless, we still did see correlations between farm size and profitability overall, and we'll explore that in the next slide. But I'll mention a few other things that were notable. The per cow production was somewhat higher in the top 25%, and milk sold per worker largely as a function of that higher per cow productivity. The number of cows per worker was pretty close, but because they were milking more productive cows, they had more milk per worker. So that helps. And then the other thing was they had a milk price received of about 10% higher. And that could be due to a number of factors. It could be various premiums that they're getting. It could be higher components, probably most likely, a number of factors. And then that resulted in significantly higher profitability and of course, subsequently significantly higher return on equity of the farmer's investment. If we look at farm size and profitability, we broke it into 3 size categories. So under 300 cows, 3 to 7, and 700 plus cows. And we can see, you know, pretty correlated information in terms of milk per cow, milk sold per worker, net cost of production sort of declines. It certainly declines from the 300 and the under 700 to the 700 plus. But notably, the 3 to 700 cows were not in the middle in terms of profit or and net cost of production. They were the lowest, and that tells me that these, you know, I guess mid-sized farms, you could say in terms of the study, although you could argue that 500 cows is already a pretty big farm, but that it's somewhat of an awkward size and that they have big farm costs and challenges and small farm resources. So some of these farms had, you know, had higher net costs of production. Their milk price received was exactly the same as the smaller farms, but their net earnings per cow were a little lower. Also notably, the largest farms tended to be more leveraged by a little bit. Rob, do you have any comments on the size distribution and what we saw?
No, I think you hit most of it. For Pennsylvania, obviously, a lot of ours fall in that 299 cows or fewer. So it's one of those things. And we saw a similar thing when we analyzed just the Pennsylvania data, that with farm size, we tend to have a little bit different distribution on production. Net cost of production tends to be a little bit higher, or a little bit similar between those small and medium-sized farms. And then we usually see a little bit of an advantage there once we get into the larger farms.
Okay, thank you. If we move on to cash flow, so these profitability numbers are on an accrual basis. So we adjust for inventory changes. We include depreciation. We do not include debt principal payments. We include interest, but not debt principal payments. That has to come out of profits. So if we look at cash flow, the cash required does include debt principal payments. So here we can see, we look at the milk price, we look at the cash required, including those debt principal payments. Then we subtract the other farm income, like I explained at the beginning of the presentation. And we come up with what we call a break-even milk price, basically what the farm would need to receive to break even on a cash basis. And so this year, or last year, I should say, 2023, that break-even milk price was $23.16, which unfortunately was higher than the actual milk price received, resulting in that negative cash margin. So what that means is that some farms borrowed money to make up that shortfall. Other farms lived off depreciation. Other farms, you know, took it out of retained earnings or savings, but it was a relatively lean year on a cash basis. We can see the big cash margin in 2022, which was significant, and then you know, a decent one in 19, and a couple mezza years here in 2020 and 2021. This chart looks at it over a longer period of time, going back to 2011, And we can see that with the exception of 2022, it's been a tough stretch. We haven't seen good profit margins on a consistent basis since 2014. We had 3 years of roughly break even, a shortfall year in 18, an okay year in 19, and then 2020 and 2021, pretty modest cash margins. And then 2023, where a modest shortfall again. So this means that, we see the debt per cow creeping up. We see the trade credit creeping up, the average accounts payable term, farms paying their bills a little more slowly, some of those things that, a lot of farms caught up in 2022, but it was a tough stretch for a number of years, I guess is the point there. And then that is reflected in the average liabilities per cow. And we can see almost 3 sort of phases here. And obviously there's an impact from inflation. $6,000 in 2023 is not necessarily triple what the value of $2,000 would have been in 1979, because we got a lot of inflation going on. But if we look at it just on a nominal basis, we can see that it took almost 30 years to go from 2 to 3,000. It took about 8 years to go from 3 to 4, and now we're almost to 6 in just a few years. So with that doesn't mean that farms are necessarily in trouble. The average net worth remains strong at more than 65% net worth, meaning that the average farm, if they had to sell everything, they'd have enough money to pay off all their liabilities, plus have a significant amount left over. It means that 66% of their assets are their own, and less than 50% are financed. But it does show that there's an increase in capital requirement to be in the dairy business recently, and that's growing, and something to keep in mind of. And it raises the stakes a little bit when you have pretty significant debt payments that you have to make every month. You have a little less margin of error, if you will. So, and that's something we saw both across Pennsylvania and in New York. Rob, did you want to comment on this at all?
Yeah, just a little bit. You're spot on. I think a lot of it is looking at the cost to update and do facilities and maintain some of those assets are demanding a higher loan factor to it. And so that with a tight margin, it becomes a little bit more critical to evaluate just how farms are going to reinvest in the business and in facilities for the long term.
Yeah, well put. So to sum up, key points: profitability declined as milk prices fell while input costs remained elevated. Cash flow, including debt service, shifted negative. Just to restate, the 2023 milk price was almost $4 below the 2022's milk price. Net cost of production fell by about a quarter. We saw positive correlations between farm size and profitability, but a wide range of financial results among farms. Farms of all 3 size groups were seen in the top profit quartile as well as the bottom profit quartile. Bigger farms tended to be more likely to be in that top quartile, but not exclusively so. And then we saw some differences between farms in Pennsylvania and New York and New England, at least in our sample. It's possible that if we had a completely 1-for-1 sample of size, that we might have seen fewer differences between the regions that we looked at. But we have to rely on farms affirmatively opting into the study. So we get what we get in terms of the sample, and that tends to be larger farms and tends to be more profitable farms. So with that, my email is on the screen. Again, if you would like a copy of the report, you can find it at farmcrediteast.com. It'll be posted on the farmcrediteast.com/webinars page, as well as the recording of today's webinar. I do not see any questions that came in for me, so I'm going to turn it over to Corey Geiger and let him give his market review and talk about how the future is bright for dairy. So let me change the presenter here. And Corey, you should see a box pop up on your screen. Let me know if not.
I am, for
You
some
don't see it?
reason, not.
Okay, let me try it again.
All right.
There we go. We can see your screen now. Perfect.
Good.
So I will let you take it away, Corey.
Excellent. Thank you for the mechanicals here. Getting computers to work in this era of IT and being very cognizant of there's people out there that want to get into bank computers. I actually have two of them going here. I have a MacBook Pro that's got my webcam going and my presentations on my CoBank computer. Pleasure to be here with the Farm Credit East folks and all the farm credit associations throughout the Northeast. Spent 28 years on the editorial team of Hoard's Dairymen, a sixth-generation dairy farmer. Our family has been in Wisconsin dairying since 1867 and been very involved in the industry. I'm currently on the World Dairy Expo Board of Directors and past president of Holstein USA, and very involved in dairy cattle genetics as well. We're going to go on a quick tour of what the landscape looks like in dairy and what the future could look like. One thing here, we've been growing as a dairy industry, and I always remind people in livestock, we don't count heads as much as we count hundredweights. And so in the past 25 years, we've only grown 2.6% when you look at dairy cow numbers. But when you look at the growth in milk production, we've grown a remarkable 44%. It speaks to efficiency, it speaks to sustainability, as we've grown milk supply from 157 billion to 226 billion. Now, Chris talked about this, and you looked at the different farms on profitability. I think as an industry, we really need to start looking at total pounds of butter, fat, and protein combined, especially in 92% of the markets that pay on multiple component pricing. So since 2011, the US milk supply has grown 15.4%, but butterfat production has grown an incredible 27.9%. So if you look at that bottom graph, prior to 2010, if we talk growth in milk production or butterfat production, it was one and the same, 24.1 versus 24.2%. They're equal. Since 2011, the dairy world has changed. Butterfat is way outpacing milk production growth. And so I remind people that milk is a living, breathing, it's a commodity. I mean, from some regard, but it's changing. It's not like number 2 yellow dent corn that's really pretty, when you trade it, you get the same things. This slide here is change in butterfat levels in the United States dating back 100 years, 1924 to the current, and we are coming on 3 years back to back to back that butterfat has set new records. Think about it. From 1966 to 2010, butterfat levels in the U.S. milk supply ranged in a real tiny window 3.65 to 3.69%. So when we talk milk, we talk butterfat, they were all the same. Now, it depends what kind of processor you are, what you're going to do with all that extra butterfat. And I would submit, if you're making mozzarella, you don't need it all. But if you're producing other products, it's in short supply. I wanted to take a look what's happening in the Northeast. What's happening in the Federal Milk Marketing Order System? That's that FMMO acronym. So the blue lines in this chart show butterfat levels on the left in the national milk supply. About 70% of it's in the federal order system. And that chart on the right shows what's happening in the Northeast. And you can see there's been a major shift, upward shift. The green lines are what happened in 2023, and we're growing in 2024. If I put that data here, obviously we only have half a year. We're sending more and more butterfat to our processing plants each and every year. The protein story is largely the same, not as big as a shift, but again, blue is this is a shift in 4 years. If we'd have done this 20 years ago, those lines have been sitting right on top of each other. Now I'm going to back up just a second. Butterfat, one way we can change it is the rations we feed our cows. Number 2, is through the genetics that we're using on our cows. It doesn't matter if you got Holsteins, Jerseys, a mixed breed. The bulls that are being used today produce more components. And there's a lot of reasons for it. 92% of the dairy farmers in the US are paid on multiple component pricing. So everyone who follows the data sees this. Those green bars that are pointing downward and you see there's 12 of them in a row that are pointing down. That's the change in US milk production in the last 12 months. 12 months in a row, milk coming off the US dairy farms are down. That's been the storyline. However, there's another storyline out there. And this data, those blue bars that are pointing up, is when we take the national butter fat. So that number is very robust. We get a good metric on it. Protein's a little more sketchy because protein comes from the federal orders. You have to be pooled milk. And the fourth largest dairy state, Idaho, is not in a federal order, but it's a great proxy. So the component supply, what most manufacturers want, is growing. And those are the blue bars. And that's a very important story here that's taking place. So we're going to go through dairy products real quickly here. Dairy industry, folks, remember, dairy is the largest category in the grocery store. It's larger than number 2, which is alcohol, wine, beer, and all the spirits, and it's growing. It's up 15% on a dollar basis in the last year, and it continues to grow. That green chart there is consumption since 1975. That number, that 653, would be like if we shipped 653 pounds of milk from our farm, it would then be converted into dairy products. Could be fluid milk, could be butter, could be yogurt, could be cheese, but that's what the average American is eating these days. So you can see that's an upward trajectory, and domestic dairy consumption is the highest since 1960. Cheese has been the market leader in growth. You can see these snapshots in time. We're looking at 1970 to 2022 on the consumption graph. Consumption data for 2023 won't be released till November from USDA, but cheese has largely been growing by 10 pounds every 2 decades. And mozzarella has grown a great deal. It was an infant cheese, basically. It was a little toddler in the 1970s. Then came pizza, and the two became hitched and have grown ever since. You can see cheddar is growing some. And then it's a small category, but Hispanic style cheeses are growing. We have a lot of Spanish-speaking people in this country, especially in the Southwest, and they want cheeses they're familiar with. So we're meeting that market demand. They're a little bit softer cheeses, and we're exporting quite a few of those to Mexico as well. So I always, how optimistic can we be on cheese? If you look to Europe, our friends in Europe are eating a lot more cheese. Denmark and France are at 60 pounds per capita. Austria, Finland, Germany, Greece, Netherlands, and Switzerland are over 50 pounds. So will we reach 50 pounds for an American by 2040? I believe we will. We might do it before then. We just had a new report come out for CoBank, and you can just Google it by Googling CoBank KED, K-E-D, and you'll find that report. We're really looking at what are growth categories for dairy. Snacking cheese is going to be a big one of them. Right now, it's projected to be a $75 billion category in the world. If you remember the 76 billion number I said earlier, that was US. But snacking cheese alone, 75 billion in the world. 23.9% of that would be in North America, largely the United States. Compound annual growth rate of 6.5% through 2034. So for example, Agrimark in the Northeast is making some snacking cheese packages. That would be pairing cheese with cheese or fruit, cheese or meats or other shelf-stable products. Americans snack 1 to 3 times a day. So this is going to be a big deal. And the chart here is showing the introduction of new snacking cheese launches in U.S. dairy export markets. You can see it started at the beginning of the pandemic, and it has been growing ever since. Real quickly, cottage cheese. This is sometimes people are a little down on social media, but here's a big win for social media. People are putting cottage cheese on ice cream and pancakes and pasta to really boost up the protein level. And you can see on a dollar basis, sales are up 16%, volume is up 7.7%. A co-op like Upstate Niagara is making a lot more cottage cheese out in New York these days to fill market demand. We know the story about fluid milk. Remember, 1/3 of beverage fluid milk gets consumed on cold breakfast cereal. Cold breakfast cereal sales are down even more than fluid milk. So if we could stabilize breakfast cereal, we already have a win. But there are some areas of promise in fluid milk. Whole milk is up 11% since 2010. We're reducing the sugar levels in school milk. There was a study in the Cincinnati market. They sold lactose, or not sold, but provided lactose-free milk in Cincinnati schools and found a 16% boost in milk consumption and 7% higher participation of taking milk when it came to lunchtime. That's a big deal because 120 million Americans, we have a population of about 330 million, but 120 million of our people in our country list lactose intolerance as an issue. And so lactose-free milk is going to be important. The other thing here, ESG, actually I put the wrong acronym in there. It should be shelf-stable milk. Is now 10% of the fluid market here, and that's things that you won't necessarily see in the dairy case because they don't need to be refrigerated. Butter is making a big resurgence. You can see butter consumption from 1925 to 2020. Butter is back. It's because of flavor. It's because science on saturated fats have changed, and we're no longer deeming them an issue with cardiovascular health. And actually, Mayo Clinic is now doing some studies that to see if the fats found in dairy products are actually beneficial to the human diet and cognitive health. If you remember the yellow slide earlier that talks about record butterfat levels, the question is, are we making enough butterfat in this country? And the short answer is no. The chart on the left is butter imports into this country since 2011 have grown 12-fold, from 10 million pounds to 123.9 million pounds in the last year. Then on the chart on the right is another measure. What are we exporting when it comes to dairy products? If you measure it by milk fat basis, the milk fat, the butter fat is still in the product. We're only exporting 5%, and that number really hasn't changed from 2011 to 2023, and that's when that butter fat boom started. But if we look at a skim solids basis, and skim solids is this for us, got people that really, a term we use a lot in processing. What's it mean on the farm? Before we homogenize milk, before we disperse the fat globules years ago, cream would rise to the top. We all know that acronym. Well, it really happens in dairy. Cream does rise to the top. So if you skimmed it off, you'd have the liquid and the milk proteins left. That is largely what we're doing with our exports. We're sending protein around the world and keeping the butterfat here because we're really a butterfat deficit market. I share that because the trend is, if you're a dairy farmer, think about making more butterfat. What's the future for U.S. dairy plants? My co-worker Abby Prins made this chart. This is where plant expansions are happening in the United States. Grande Cheese just announced one earlier this week in Wisconsin, so we got to add another orange dot there for a class 3 plant. But the processing capacity is the growth from 2019 to 2022 versus 2023 to 2026 is going to double. Cheese production, 1.1 billion pounds. That's a lot of cheese. You can see some of the activity in the Northeast. By our estimates, it's 1.8 billion of the $7 billion number that we're quoting world in the U.S. But Great Lakes Cheese is doing a cut and wrap. Cayuga is doing some fluid milk. HP Hood is doing fluid milk. Wells Enterprises is doing ice cream. Fairlife fluid milk. And then I believe was an announcement by Co-op in New York earlier this week too. There's 3 ways to move more cheese: retail, food service, and exports. Food service has been sputtering. There's a lot of reports. Inflation has impacted middle America, the middle class. And you could see that chart on the right, the Gallup poll. That's an open-ended question. What's the financial problem you're seeing today? And inflation, in an open-ended question, from 2020 to 2024 has jumped up 41%. So for retail, you're going to have to, or restaurants, you're going to have to see more deals to lure customers back in. Cheese exports are on a record pace for this year. Also, CWT cooperatives working together are going to be revamped here and have a new plan for 2025, and that certainly will involve cheese. You can see the pace of U.S. dairy exports. 2020, 2021, and 2022 were all record years. 2023 fell off pace a little bit. Remember, when you look at 16.5 to 18% of the U.S. milk supply, we're growing exports while we're growing milk production. It's a positive story. You can see this here. Two things to remember about dairy exports. China is the world's largest dairy product importer. 20% of the globally traded dairy products are purchased by China. Now, China's sputtering a little bit, and their GDP was approached 75% of that of the US, which means it was a growing economy. And now this past year, it slipped back to 64% of the US's GDP, and that's back to 2017 levels. So those are some of the reasons China is buying less. Now, I said there are two things about dairy export. China is the biggest customer. New Zealand is, I'm going to restate that. China is the biggest dairy product importer, and New Zealand is filling a lot of those markets. And number two, Mexico is America's biggest customer. So it was the first $1 billion market, and it's moved over to $2 billion. So you can see the yellow bars here are cheese exports were easily on pace to make a record year here. Now, a lot of those exports were made when cheese prices were lower in the year, but never before in US history have we exported over 1 million pounds in a month. We shattered that glass ceiling in March at 110, and then April came in at 102, May came in at 106, and Mexico was the biggest buyer at 38 million pounds in April and 40 million pounds in May. We're going to switch gears to get back on the farm here. This slide, when you look at that chart, that is the semen sales to beef semen sales in America. And you can see beginning in 2017 to 2023, they've shot to the moon. What happened then? Purebred bull calves just weren't worth much, especially Jerseys and for sure even Holsteins. So dairy farmers began using beef semen on a portion of their dairy cows as the premiums for these calves have grown. At one point, they were worth $500 to $600. Now, people are easily getting prices of $800 to $1,000 for these calves at 7 days of age. You heard Chris's numbers earlier, the cost to raise heifers. Add $2,000 on there and you got a $3,000 heifer. You can see the shift. There's about 3 to 3.25 million beef on dairy animals out in the countryside, and that's an estimate from Dale Warner at Texas Tech University, who follows these markets quite a bit. Of that 2023 total, those 9.4 million units, the National Association of Animal Breeders knows that 7.9 million units of that semen went to dairy farmers. Dairy farmers are the reason for this trend. The trend is not going away. Here are the demographics of the beef and dairy cow herd. We're at the lowest cattle inventory since 1951. We're at the lowest beef cow inventory since 1961. We're at the lowest feeder supply since 1972. As that all happened, go back to 1951 to the current, the US population has grown 126%. So more consumers are craving beef and we can't make enough of it. That means these beef on dairy calves are going to be worth quite a bit for the foreseeable future, because livestock producers are also getting a premium for them, and they're not keeping them for cows, they're sending them to slaughter more. And my coworker, Abby Prince, just released a paper on that this morning at noon Eastern Daylight Time. So you can Google CoBank KED and find her paper. So dairy semen sales are down because we're buying more beef semen. And you can see the units that are down there on the left. As a result, dairy replacements, 500 pounds or larger, a big proxy for what's going to enter the dairy herd, is at the lowest level in fell 709,000 head in 6 years. and now the lowest level in 20 years. Very quickly, the replacement market has changed. Last year, about this time, you could have bought any heifer you wanted to enter the cow herd at about $1,600, maybe pay a little more for a premium one. Those prices have doubled. You know, Rob and Chris were talking about the cost of buildings and expansion. Those numbers are probably almost doubled here in the last 5 to 7 years. So you add on top of that, and the cow supply, you can't even find them. That's going to be a lid on milk production for a while. Dairy farmers are pulling way back on sending cows to slaughter. You can see that all changed. The red line there is 2023. In about September, culling activity pulled back because dairy farmers realized, holy smokes, there's not enough replacements out there. And it continued into 2023, which is the green line. I think we need to talk about HPAI, highly pathogenic avian influenza. Officially got recognized in March of 2024, probably was around for a while. It's going to continue to make headlines. It's endemic in the wild bird population. So between that and poultry, it's going to be around. But we have to remember positive cases have only been detected on 0.6% of US farms. There's no positive cases in the New England and Northeast states. The top 2 dairy states, California and Wisconsin, have no detected cases. You can see the states that have been impacted. We do want to call Colorado out. They have the most cases detected. The state has made a mandate that all herds must test. So we're going to hear more about Colorado over time. Good news on the dairy front. Feed costs are falling. My dad passed away about 5 years ago. I run our 400-acre family farm. In May, I sold some of my soybean crop. And since I sold it in early May till now, the markets for new crop soybeans have dropped $2.07 a bushel as of this morning. Corn has dropped 67 cents. So if you're not growing it and you're buying it, this is a big deal. If you're growing it and running it through livestock, animal protein, or dairy, that's going to be beneficial. You can see soybean prices, meal prices, how they've dropped here since January 2023 to the current, and the same for alfalfa hay. Feed costs are coming down. That is a positive theme if you're a dairy producer. Futures markets here, you can see they're inverted. What does inverted mean? Typically, class 3, the blue line, is above the class 4, the green line. Class 3 is cheese and whey. Class 4 is butter powder. And so that's an unusual situation, partially driven by the amount of new cheese capacity coming online. For dairy farmers, and that implies to all of the Northeast states, and milk checks in 2023, 58% of the value was butter fat, 31% was protein. So even if your processor has supply controls or base excess plans, there are no penalties for sending more components because that's really what they're needing for processing. You can see the futures market don't look too spectacular here in the long term. I think we're going to see that for a while here because of many other the egg commodities are down, but dairy should be strong and so should beef. And so they're just people not making decisions in the long term, in my opinion. You can see the forecast here based on dairy margin coverage. We should be in for a good second quarter of the year and moving into the new year. Those dotted lines are the forecast moving forward. I think the Northeast, we have to remember the Northeast superpower is consumers. This was a slide I shared earlier in the year with the Northeast Dairy Business Innovation Center. The Northeast has a land mass of just 16%. You have close proximity to a great population base, and it's growing. And consumers want nutritious dairy products from local farms, and your proximity to that market is going to be important for you dairy farmers moving forward. I also share this slide here. This is based on U.S. milk production and the U.S. population. So when you look at the Northeast and the New England states, there are only 3 states that are surplus for milk: Vermont, New York, and Pennsylvania. That means those dairy farms in those states produce enough milk to supply all the dairy product needs and really have some to export, and export can be sending it to another state, right? So there's a lot of milk deficit states in the New England and Northeast, Maine, New Hampshire, Maryland, Connecticut, Delaware, Massachusetts, New Jersey, and Rhode Island. So those are also market opportunities. When we talk about U.S. dairy product exports, the supermajority that's always west of the Rockies from those states there. It takes extra money to move it from the middle west. But that's where we're at there. We're going to stop there. I think that was my last slide. And if Chris wants, he can pull back controls here. And we'll take any audience questions here. We're about 10 minutes from the top of the hour. So Chris, back to you.
Yeah, thank you very much, Corey. A couple of questions have come in. One is noting the increase in components of milk production nationwide and the increased protein and fat content that dairy farmers are producing. Do you have any advice for a dairy producer? Should you always be chasing higher components, or is there a point of diminishing returns because obviously you have to invest more in feed and other inputs to get there?
Mm-hmm. So I think it's something that dairy producers got to be continually thinking about. I didn't have a slide in here on genetics and sire selection, but the era of genomics has rapidly changed this outlook. And again, number one reason is nutrition, what we're putting in our feed in front of our cows. But number two is genetics. And investing in good genetics will pay more dividends than ever before. And remember, most of us keep our heifer calves, so we're growing that. It's additive. It's not like investing necessarily in seed corn or alfalfa, where we at some point terminate that crop. Now, on the feed side, there is a point of diminishing returns chasing components. I think you really got to look at, butter fat is still a premium. It's probably good 55 to 65% of the milk check in any given month. So it's really a partial budget analysis of how much you want to push that envelope. But we're not getting paid for the water in our milk unless we're in a skim solids market, which is the Southeast or Arizona. So I think as time moves on and Farm Credit East looks at the numbers amongst their dairy portfolio, it's going to be the dairy farms that ship more, and we're getting paid for pounds and protein. You got to be very clear on that. But these percentages are a good proxy for what we're sending. And another part here is this isn't taking place necessarily by a change in breed composition. If you look back to 2000, 92% of the bull semen sold was Holstein. That number is now 83%. So there's a 9% shift. And most of that's been Jersey. So Jersey population or semen is up to 14%. But predominantly, we're doing this through work within the breed to change component levels.
Great, thank you. Excuse me. Another question came in about what you see for 2025, looking at futures markets and that sort of thing. What's your biggest takeaway, for the coming year, and in particular with not just milk prices, but producer margins?
Mm-hmm. So the one thing we know right now is the swift and quick movement on the grain side of this. Any of those commodities, and hey, there are opportunities now for dairy farmers to lock in their feed costs all the way through the next cropping year and really lock in some really low feed prices. So that's, feed and labor are our two biggest costs on a dairy farm. So that's a new opportunity and something that needs to be looked at very closely by everybody. Milk, you saw that slide a couple back here, and I'm going to pull that one back up here. We have a good projection of what the fall is going to look like, but people aren't quite sure what the new year is going to bring. My crystal ball, and everybody's crystal ball has different levels of clearness. Mine's probably partially clear, sunny, and partially cloudy here. I don't see the U.S. milk supply growing very quickly here because we're capped by the number of replacements. We're not magically going to make more dairy replacements. And even if so 54% of the bull semen sold last year for dairy was gender sorted to make a heifer calf. Now, dairy farmers can use more of that semen and still capitalize on beef on dairy. But even if we breed those cows and heifers today, it's 3 years out before we have more replacements. So this is a unique moment in time, never happened in my life, that we're capped so much by replacements. And then the other two big dairy product exporters, the EU and the European Union and New Zealand, don't show a whole lot of signs of growth. So if demand stays strong, I predict in my crystal ball that 2025 will be a better milk price year than those futures are showing right now. I mean, right now, I wouldn't personally lock in those prices if I was running my farm. But I think there's more upside based on what's on that chart.
Okay, great. Another question for you is that in the Northeast, many, well, I don't know about many, but at least some milk buyers have base excess programs that are designed to manage supply and penalize expansion and or limit expansion. What do you see for the future of those among milk buyers, I guess nationally, but particularly in the Northeast?
Mm-hmm. So I look at base excess programs in a different way. So if somebody's using the word penalized, I would say their perspective is I can't ship all the pounds of milk that I want to ship. And I can appreciate that perspective. On the flip side, the Northeast is in a multiple component pricing market, and those markets are driven by butterfat and protein pounds. There are no penalties for shipping more butterfat pounds and more protein pounds. So I would suggest if you're in a growth mode, I would look at my dairy herd and how can I ship more butterfat and protein, because that's really what the processor is looking for on almost all counts. So from that standpoint, there's really not a limit on growth. It's finding a way to ship less water. I think there are some opportunities, and I'm trying to remember all my slides here, but there's some opportunities because there's plant expansion taking place in the Northeast, and those plants are going to want milk. And so I'm not finding the slide right now because I'm not memorizing my presentation completely, but those plants are going to want milk, and I think some of that's going to change over time. Here comes the slide now. So there's need for milk. This will not be a light switch, though. It's going to be a slow roll of how those, because just because a plant is being built doesn't mean, you start up at 10% capacity, 15, 20, and you slowly roll to full power. And so some of this takes time. And, these plants are coming online between today and 2026. So there will be some opportunities.
Great. Thank you so much, Corey. So this concludes the questions. Any final thoughts before we call it off?
I'm pretty bullish on dairy long term. The consumers are going to demand more dairy products, not only in the U.S. and around the world. The proteins found in dairy are the most complete known to humanity, and those dairy products are going to look different. Yogurt bars, snacking cheese, whey proteins, and all these different drinks. Coffee creamers are taking off. So our dairy products are going to look different based on the demographics, but it's still going to be dairy.
Excellent. Well, with that, we will conclude. And again, I invite you to visit farmcrediteast.com/webinars to see all our webinars, past, present, and future. We archive our past webinars there, and we announce our future webinars there. So check that out. And with that, I will conclude the webinar, and have a good day. Thank you for your attention.
See ya.